Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our every other week live Q&A. Hope everyone's doing well. In the chat, just give me a thumbs up if you can hear and see me. Lets me know, I haven't broken anything. And we'll get started. I'm just going into the chat myself here, which just takes a second. I was finishing up a speed game of chess, so I'm not really. I kind of feel unprepared. Let's see here. I see the thumbs up, so apparently I didn't break anything. I got that going for me. All right, so let's just jump right into the topic, my little short topic to get started with, and then I'll get to the more important stuff, your questions. But here's something that's maybe related to my question. It's from David. I opened it, so the topic is what happens if Savebetter goes bankrupt. Savebetter is a company, and they're an advertiser of mine. But you can open up an account, which I've done in the past. I don't have money in it now because they're on T-bills. That's another story. But you can open up an account with Savebetter. Then from that account, you can put your money in. I guess it's dozens of either FDIC insured banks or NCUA insured credit unions, and they offer, from what I can tell, some of the best rates out there. But they're not the only option. I mean, there's a lot of other good options. I mean, I put good is relative when it comes to cash, but relatively secure. You can pretty much get about 5% roughly, depending on whether it's a savings account, a money market account, a CD, a T-bill, kind of where we are, more or less. But the question has come up: what if they go bankrupt? And I'll explain why that question's come up. But let me just read David's comment. I opened a Savebetter account last month and was wondering this very thought, or more to the point, if Western Alliance Bank goes belly up. Well, that one's kind of easier, right? Because Western Alliance Bank is an FDIC insured bank, and so it would be covered by FDIC insurance. And I personally called the FDIC about Savebetter and asked them, and they said, yes, Savebetter is not a bank, but your money doesn't go to Savebetter. It goes through a service bank, Lewis and Clark, I think, to whatever bank you've chosen for your account, in this case, Western Alliance. And it's a member FDIC, so obviously subject to the FDIC limits. Your money is insured. They call that, if you want to Google it and find out more information, they call that pass-through. And I'll explain what that means in a minute. So let me read you the question I got that sort of prompted this topic. It was actually an email from a viewer, and they were quoting a comment to one of my older videos that talked about Savebetter. And let me just read you the comment. Rob, I also called the FDIC and talked to deposit insurance support specialist recently, which is what I did as well. She was also very familiar with Savebetter and did indicate that the participating banks were FDIC insured. All right. And they also work with credit unions. So just keep in mind, credit unions are insured, but not through the FDIC, through the NCUA. However, she also pointed out that Savebetter depositors have no account number or record of deposit with the banks. So just to stop reading that comment for a second, if David here called up Western Alliance Bank and said, hey, I've got a, whatever it is, I've got a CD or savings account with you, but it's through Savebetter. Can you tell me what my account number is with your bank? The answer is going to be, you don't have one. Savebetter has an account with us. And your money might be in that Savebetter account, and it's held for your benefit, and Savebetter keeps track of everything. But Western Alliance Bank, we don't know who you are. We've never heard of you. So that's true. Now, I'm going to keep reading the comment, but I have a question for you all. Does this happen in any other context besides, can you think of another situation where you might invest in an FDIC insured account, but the bank would have no record of you? All right. Where was I? All record keeping is done by Savebetter with no independent third party or FDIC oversight. Well, there certainly wouldn't be any FDIC oversight over Savebetter because Savebetter is not a member of FDIC. Whether there's any third party oversight, that's a different question. And I've actually reached out to Savebetter to see if I can get an answer to that. But I don't know how the FDIC person would know one way or another, but maybe they do. I don't know. People should understand that this is a risk that they must accept. If either a member bank or Savebetter goes belly up, FDIC coverage depends on Savebetter's bookkeeping. I contacted Savebetter regarding this response to their FDIC stated risk and was pointed to their information page, which didn't, I'm just paraphrasing now, basically didn't answer the question. So it's two things. First of all, let's answer the question that I asked a minute ago. Is this just Savebetter? They've got some weird relationship with banks that they created and it's never happened before. The answer is no. They use omnibus custodial accounts. Omnibus simply being an account, let's say at Western Alliance Bank, where they pool multiple customers' money together. And it's a custodial account because it's a Savebetter account, but they're custodians holding that money for your benefit or my benefit or whoever's got an account through Savebetter. That happens quite commonly. And a good example of that, brokered CD, right? If you look at Fidelity's, in fact, let me see if I can pull it up. So remember, what a brokered CD is, Fidelity buys the CDs from the bank, deposits money in a 1-year CD, and they put whatever they put in there, 25 million bucks, 100 million. I don't know what they do. And then they sell them to their customers. So when you go on to Fidelity's website or Vanguard or Schwab and you buy a brokered CD, you're buying it from Fidelity. The bank doesn't know who you are. The bank doesn't care. And this is explicitly in the Fidelity terms and conditions. Just like, by the way, for Savebetter, if you dig into those terms and conditions, it says the same thing, that Savebetter or their parent company, Raisin, keeps track of all the records. Let me see if I can quickly pull up the Fidelity. Here it is. So I'm on the Fidelity page here for their CDs. And I click this link here for the disclosures, and here it is. Let's make it a little bigger. You got to love lawyers and their contracts. It's only 12 pages. That's pretty short. Let's see if I can, let's do the firm. Here we go. The firm, Fidelity, as custodian, keeps records of ownership of each CD and will provide you with a written confirmation of your purchase. So that's one example of where this concept is put into practice. Another example, robo-advisors often have cash accounts that can get you FDIC insurance. You can put up to millions in some cases. And what they do is they spread your money out across, I think with Wealthfront, I think it's 20 banks. Let's see right here, 4.5% APY. And I think it's 20 banks. I don't know. Oh yeah, up to 5 million. Yeah, up to 5 million in FDIC insurance, 250,000 is the limit, so that'd be 20 banks. They're doing the same thing. It's the same concept. So this isn't like something that Savebetter came up with. Now, I suppose one could say, well, Rob, I trust Fidelity because it's a big broker and they've been around a long time, and I feel comfortable maybe with that, but I'm not sure I trust Savebetter or I'm all that confident. Okay, then yeah, that's great. Just use Fidelity if they've got a product that you like. Or if you say, I'm okay with Wealthfront, but not, or Savebetter, not Wealthfront. There's a lot of different ways to get a pretty good rate. So just pick what you're comfortable with. All of that being said, I found the FDIC specialist comments a little odd because let's assume Savebetter goes bankrupt. I'm not a bank. I was never a bankruptcy lawyer, but I handled cases, mainly litigation, that came out of bankruptcy. And so, company goes bankrupt, a trustee gets put in place. There's a special federal court for bankruptcy. And then they start suing everybody, blaming everybody for the bankruptcy, which may or may not be true. And I would often defend companies that, I shouldn't say often, I had one or two cases, but they were big cases. The data doesn't go anywhere. It's not like a company goes bankrupt and all their data is gone. Where's our data? It's just, I don't know. The bankruptcy court hit a delete button and it's all gone. I mean, so I don't know what the FDIC person had in mind. I suppose it's possible for any company's data. I guess they'd have to have their data and all their backups somehow destroyed. I don't know. I guess it could happen. And maybe banks, because they are more heavily regulated, and Fidelity, you feel more comfortable with that than say Savebetter or Wealthfront. Great, then go that route. But I've never I've never heard of a bank or any company in this kind of context losing all their data and not knowing which customers have which accounts. I will tell you that in the novel that I've been painfully working on and not making any progress, that is a plot idea that I haven't fully developed, but I've been noodling on for probably 2 or 3 years, actually. But I've never actually, in the real world, ever seen it happen. Maybe you guys have. If you have, leave it in the comments. I will say this. No matter where you decide to bank or whatever, keep a copy of your most recent statement. And we do that. I just think that's smart because I guess anything's possible. So, when I opened up my Savebetter account, I ended up, again, taking the money out and put it in T-bills because we were going to spend it. We didn't. So anyway, the idea that like they would get all the data mixed up just was not a concern of mine. But I guess it's a risk. Yeah. But again, if they go belly up, their data doesn't go anywhere just because they file bankruptcy. A bank's data doesn't go anywhere just because they go under and the FDIC takes them over. Yeah. Anyway, so that's my 2 cents. I don't know how helpful, that answer is to people that are wondering. But again, I wouldn't lose any sleep over it. If you're not comfortable with Savebetter, don't use them. There's plenty of places to get, roughly 5% on either, it's either FDIC insured. In fact, let's look at savings accounts on all cards, my site, which tracks hundreds and hundreds of accounts. Let's look at savings accounts. So, all right, now, admittedly, the first 4 are all from Savebetter. But then we have Salem 5 Direct, which I've never heard of. It's 501. Here's M1 Finance. Now, again, M1 Finance is probably a similar situation. Let's actually go to it, see if I can find it. It's probably like Wealthfront. Yeah, accounts are FDIC to up to $5 million. So I'm guessing they're spreading your money across multiple banks. And I'm sure that it's a custodial omnibus account. I haven't actually looked it up. Here's their high yield savings account agreement. Do we want to go through this tonight? Probably not. Let's just see if I can do a quick search. Here we go. Your account and ownership will be evidenced by an entry on records maintained by Stable, acting on behalf of your bank for each of the receiving banks. So there you go. I don't know what Stable is, but it's obviously not the bank. We can actually do it. Let's figure out who Stable is. They've defined it somewhere. We'll go back to the top. It's an agency, blah, blah, blah. Fees. What's the first mention? Stable. We utilize a demand deposit marketplace program operated by Stable Custody Group, LLC. So anyway, M1, 5%. New Tech Bank, 5%. What's like the highest rate from like a pretty well-known bank? CIT Bank is pretty well-known. That's 485. UFB Direct is pretty well-known. They've got a lot of assets, 481. So anyway, lots of options. I don't know if that helps you or not, but that's my take on it. I'm just not particularly worried about it. But again, I guess anything's possible. I'll let you know what Savebetter says when I hear back from them. Okay. Now to the good stuff, your questions. All right. Oh, look, Robert from Ohio, a great name and a great state, OH. All right, let's get to some questions. So Ethan wants to know, and welcome back, Ethan. Any thoughts about what maturity is appropriate for bonds? Is there any method to the madness or just B&D and chill? Well, there is a method to the madness, kind of, I think. And I wish I could put my hands on the research, but I know I'm not going to be able to, so I won't try. I personally like, for the most part, I have some in shorter term, but for most of our bonds, it's an intermediate term. And the idea is that over long periods of time, you're in a higher return than short term. Yeah, there's more volatility, but I'm okay with that. And but when you look at longer term, like long-term bonds, like 20 years and up kind of thing, or maybe more than 10 years, something like that. But you might get a slightly higher return, but the difference isn't a lot. And so to me, intermediate term has been sort of the right balance, between getting as much return as I can, but not too much volatility. And it didn't seem worth it to try to extend that out longer. I would say for me, I also like tips. So it's not just BND and chill, it's BND and an intermediate term tips fund and chill. Again, I always keep some amount of cash, and right now it's primarily in T-bills, so that would be shorter term, but I don't own any like short-term bond funds. Well, that's not true. I have a few $1,000s in one just as an alternative to T-bills, but that's neither here nor there. So that's my take. I'll have to see if I can put my hands on that research paper, but I know I can't quickly. I actually think it comes from Morningstar, but okay. Matt wants to know my thoughts on Roth conversions before 2026, and that's when the taxes under current law revert back to what, 2017 or before 2017, something like that. Staying within your current tax bracket at least 15 years from retirement. So the concept is easy. Figuring it out is difficult. So, you want to know what would be my effective tax rate, not bracket, but rate, if I did a conversion, say this year or sometime before 2026 or whatever, whichever year, maybe each year. What would be my effective tax rate, which may be the same thing as your effective tax bracket, but remember, some things, depending on your situation, you can pay more in taxes than just what your tax bracket would suggest. If, your income puts you over different thresholds, like maybe you did a conversion and that kicked you out of Affordable Care Act credits or something like that. So what would your effective tax rate be then? And then compare that to what your best guess as to what it would be, I guess for your case, 15 plus years from now. If you didn't convert now, and 15 plus years from now, you pulled it out of a traditional account and paid ordinary income tax then. So that's what you're trying to figure out. Now, if you can do the Roth conversion, say before 2026, and therefore have a lower effective tax rate, then the odds are, that it's certainly going to be a better deal than waiting until after 26. But even if you did it before 26 and you had a lower effective tax rate, it's still not going to be the right move if your tax rate 15 plus years from now, when you would pull money out of a traditional account, would be even lower, right? And you may be saying to yourself, well, Rob, I appreciate that, but that's not very helpful because I have no earthly idea what my effective tax rate is going to be 15 or 20 years from now. I don't even know what the tax rates are going to be. I think I know what my filing status will be, but who knows what's going to happen in the next 20 years. It might change. Yeah, welcome to the fun world of Roth conversions. That's why calculators, and I like the one that New Retirement's done. I can maybe show you. I did a video on it. You can check the video out. I like the Roth conversion, particularly the one where you fill up certain tax. You can pick which tax bracket to fill up each year. But at the end of the day, in many cases, it's kind of a guess. There are extreme cases. You retire, you have very little income, you're living off taxable assets, and you fill up, a really low tax bracket on conversions, and it's kind of a no-brainer. But in many cases, it's a tough call. Steve says, I read your quote in the recent issue of Kiplinger magazine. You mentioned that you moved away from Vanguard for most of your investments. Where did you go? I forgot that came out. They interviewed me for that. I should look at it. I don't know. What did I say? Kiplinger magazine, Rob Berger. Will it come up? The first thing that comes up is Kiplinger's Personal Finance Magazine's Ugly Truth. I don't think that's about me. I can't find it. I'll have to look it up. So I still own Vanguard funds, but among others, but I moved away from a lot of out of their the Vanguard brokerage because I just wasn't happy with the services. I will tell you, rather than tell you where I went, I'll tell you which ones I like. I still like Vanguard, and if you just have sort of basic mutual funds, you don't need a lot of services from them, or ETFs. There's no reason to leave Vanguard. But if you have business accounts, Vanguard I found very difficult to deal with, and the services have hopefully they improve it. I'm a huge Vanguard fan, so I'm rooting for them. I like Schwab. I like Fidelity. Fidelity is probably my favorite of all of them, just because of the customer service, the services they offer. I think it's probably the best. Certainly, it's one of the best. For robos, I still like Betterment. I like Wealthfront. I think those are both good ones. Trying to think what else. It's probably about it. But I like Vanguard too. It's just their services have not been great. I need to find that. I knew it was getting published. I didn't know when. Well, this is a tough one from Rap Freak. By the way, welcome back, Rap Freak. Any advice on how to open a conversation with aging parents on estate planning wishes? A life of sacrifice and investing could be easily wiped away with scammers or poor decisions scams. Well, it's a good question, and it's not an easy one to answer. Obviously, a lot is going to depend on the specific individuals, your relationship. Assuming you're like the son or daughter talking to your parents, do you have siblings? That can really complicate things because things can get very touchy if one child's talking to the parents and excluding a sibling or more, and So I tend to think you ought to get everyone involved, but that's a gross generalization, and I understand there could be times when that may not be possible. And you also have to assess how open the parents, aging parents, are to that kind of conversation. For us, it's been fairly straightforward, and no one's had any trouble having the conversations, and it's worked out well. Things can get tricky, particularly when you deal with things like real estate, and it gets passed down to multiple children. Now, what are they going to do with it? I mean, if all of them agree we're going to sell it, okay, no big deal. What if one doesn't want to sell it and one does? And it can get difficult. I have a friend whose parents had a second home, and through discussions with the parents, they ultimately convinced them to sell it because for the siblings to inherit it, it would not have been a good situation. And one of the siblings, I think, was a little upset about the sale, but didn't end the relationships at all. And they did sell it, and it was probably the smart thing to do. Now, there are tax consequences and things to think about there. If you inherit real estate, you get a stepped up basis. So, there's a lot of things to consider. It could help to get a third party involved, like the trust and estates lawyer that might help the aging parents. I think a lot of times having a sort of an objective third party involved in the conversations can help a lot. At the same time, I'll just finish with this. I don't know how helpful any of this has been, but there can be some situations where the parents just don't want to have the conversation. You can't force them to. So that's just sort of the reality. Yeah, look, you guys were answering my question from earlier. Brokered CD. Yep, there you go. Clarice, thank you for the newsletter. So I send out a newsletter every Sunday. I actually send out two of them now. One kind of related to this show, and then I reacquired dollroller.net, my old website, and I have a newsletter that goes out for that. Anyway, thank you for your newsletter link on the Apple Provision. I watched the Apple event on it and was really impressed. Great to read the review on it. I think so. Some think it's just awesome. Some hate it. Whatever. I watched the event and the video. I think it's extraordinary. Now, I also think that 10 years from now, it'll be like looking at the first iPod or something. I mean, it'll be like, can you believe we were wearing that thing on our heads? But it's an amazing piece of technology, and I just can't help but think that it's going to end up being a major part of Apple's business. Maybe not the first version of it, although I will get one. I've already said that. That's publicly. When I get it, it's not till next year. I'll wear it on the show. I don't know why I would do that. I have no idea. But I was amazed by the thing. All right, we got to help a young investor, Avo. Hope I'm pronouncing that right. I'm a young investor suffering from analysis paralysis. Thoughts on going 100% VTWAX in a Roth IRA as opposed to some breakdown of VTSAX and VTIAX. Well, I personally would prefer the breakdown because I like international exposure. Let's look at these just so we're all on the same page. We'll look at these two funds. So VTSAX is the Vanguard Total Stock Market Mutual Fund. It's the same fund as the ETF VTI. It's an incredibly diversified fund. If we look at the portfolio, we can see that this one fund, it would invest your money, you can see it right here, in 3,889 companies. So let me make sure the comment's not in the way. We'll take the comment off. There we go. So it's an incredibly diversified fund. Now, all of the companies in this fund are headquartered in the U.S., but still they do business around the world. I mean, look at the top 10, Apple, Microsoft, Amazon. I personally like to have international exposure. So VTIAX is the international stock fund. If we look at its portfolio, I think it has even more companies. Yeah. Look at that, 7,892. So if you own these two funds, you'd have over 10,000 companies that you would be part owner in. And you can see the list is very different. And it's also more, it's not as heavily concentrated as the US fund because of the companies like Apple and Microsoft make up a lot of, in the top 10 generally make up a big chunk of it. But so I personally would prefer, if it were for me, I would pick both of these funds. I don't know what percentage I'd put in each. Might be 65% US, 35% international maybe, but there's no right or wrong answer. Having said that, I'm guessing, this is just a guess, let me put your comment back up. I'm guessing the analysis paralysis is because the international fund hasn't done as well over the last 10, 12, 13 years. Although this year, it may be doing better this year. I don't know. Maybe it's not actually. And so you have to decide what's best for you. But I wouldn't lose any sleep over it. Pick one or the other. But I mean, in an ideal world, you'd pick the combination, the approach that you can stick with. I just like the international exposure. So I have an international fund. It's not that one, different one, but very similar. Because I understand that U.S. stocks have outperformed international, but that's not going to last forever. It's just not. And I believe that I'm better able to withstand slightly lower returns with international exposure than I think I would be withstanding significant lower returns at some point in the future because U.S. stocks really underperform. That's me. You may be different, but that's how I think through it. And so I like the international exposure. But again, you've got to make the decision you're comfortable with. So this is back to what we were talking about at the top of the show. We can look at it, but I'm sure they do as well. So I'll pull this up. Basically, anytime you're investing, say in a FDIC account, but you're doing it through an intermediary like Betterment, it's going to be that kind of account. I'm reasonably certain. Yeah, so you get 2 million insured, so they're spreading it out over, obviously multiple banks. I won't go through and try to find the agreement. You can certainly do that or reach out to Betterment if you want to know for sure. But that's my guess. The nice thing about it, well, it depends how much cash you have. But I guess if you have a lot of cash and you want FDIC insurance, the nice thing about it is they'll spread your money out for you over these different banks, and then you get extra FDIC insurance. Ethan wants to know the last concert I went to. We went to some band, and I don't remember who they were. The last one I remember was decades ago, and we saw, I'm not a big concert person, but we saw Elton John and Billy Joel, and that was fabulous. I haven't been to one since then, because that was probably, goodness, I don't know, 20, 25 years ago. I just don't remember. I don't remember the name of the group. All right. So Chris has a good question. What do you? He didn't tag me, but I'm going to answer it. What do you think of a 5% withdrawal rate from ages 55 to 67, and then 3% withdrawal rate at 67 and beyond, but having Social Security? So my gut instinct tells me that's perfectly fine. I mean, again, based on historical data, I mean, the world could fall apart tomorrow and all bets are off. But at least based on historical data or some reasonable Monte Carlo analysis, that would be, it strikes me as reasonable. Now, what you can do, and I will go ahead and pull up new retirement real quickly, because you can model that. So I'm pulling up my demo account I'm trying anyway, of new retirement, which is to say this is not my own personal information. It's information I just made up. And let me see if I can remember how. So if you look at, so I think actually the way you would do this, you would have your, actually it's actually simpler than I was first imagining, because what you're going to have is your whatever, this is just a made up number, but you're going to have your annual expenses, right? Or this is monthly, but you're going to have you're going to put in your expenses. And based on your question, let me take your comment down. It's going to equal, let's say, 5% of your assets that you've got listed here, right? And it's going to be adjusted for inflation, and you'll assume an inflation rate, but then you'll get down to income, and you'll set your Social Security up, and you'll set your start collecting date for when you're 67, which will generate whatever monthly income for you. And then you can, run the numbers, and it will tell you based on the assumptions. And I would look at assumptions based on optimistic, average, and pessimistic. And you set the optimistic and pessimistic for both returns and inflation. The average is just the mathematical, the mean of your numbers. And I've got a whole video on all of this. And it'll show you your chance of success. I would put it more like your chance of not having to modify your plan. There are other ways to do this. You could use Maxify. I actually Larry Katlikoff, I hope I haven't mispronounced his name. He's a professor of economics at Boston University and the founder of Maxify. He and I have had some fun exchanges. I was on his podcast. I'll drop a link to it in the newsletter that goes out this Sunday. But Maxify is another tool you could try. Projection Lab might do this too. I'm guessing you could do this with Projection Lab. I've talked about that one. But you could model it, is my point. I don't know that it matters, which tool you use. It matters, but many of them will, I think, do a reasonable job. The interesting thing that Larry and I were debating, I guess, was the difference between what he calls a sort of an economic view of retirement planning and conventional. So he points out that under the conventional way, you figure out your spending first, and then will my assets support that spending? the way he prefers to do it is to say, well, let's just look at your assets and let's figure out on what's called consumption smoothing. You're going to basically consume the same thing on an inflation adjusted basis throughout retirement. How much can you spend? And there's the number, and you can work within that number. I personally don't know that I see much of a difference, which maybe to an economist, that's, a big difference. But to me, I think both numbers are important. I like to see just here's my assets. How much can I spend? All right. Here's what I actually plan on spending. How will that work out? I like to see it from both angles. And most of these applications will do that. Anyway, Chris, hope that answered your question. You could use a tool to model this. They all cost a little bit of money, but I think they're all reasonable. Okay. Now, Caleb says, and correctly, the majority of your sequence of returns risk is at the beginning of retirement, so having a higher withdrawal during the period increases the risk level. I think that's a fair point, but again, 5% is not that crazy. And then, you're kicking in Social Security. But again, that's why these tools are so helpful, because, Caleb, his point you can run different scenarios where you can assume the sequence of risk turns out bad for you. You can assume a certain rate of return, say for the first 5 years or whatever, that's maybe really low. And just play with the numbers and do what if scenarios and so forth and so on. All right. Of course, Rob Berger's novel involves FDIC insurance. Not exactly. Although maybe that would be my main character, an FDIC sort of auditor. No, I have a lot. The problem with the novel is I have all these plot ideas, and it's trying to get them. Some of them are out there. Trust me. I'm almost a little afraid to let people venture into my mind by reading my stuff. It's like, oh, I feel sorry for Rob's wife. Okay. This is an interesting question, Marcus. I was actually thinking about this very thing. Should the 3-fund portfolio now be the 4-fund portfolio, with the bond portion being 50% B&D and 50% tips? I will say that is certainly my preference. Yes. And that's basically how I have my bonds structured. Again, I have some in T-bills, but and I don't know of a fund that mixes the two. Maybe there's some fund out there that does. And so you could keep to a 3-fund portfolio, but yeah, I don't see why you wouldn't have some tips. Yeah, I guess, you could play with the numbers. Maybe for you, it's not 50-50, but yeah, I kind of think that might be true. Of course, I suppose you could then use for domestic and international, you could just use VT and you're back to a 3-fund portfolio. But I had someone email me. I think they're upset with me, but I couldn't quite tell, because they seem to suggest that what I was advising is different than what I do. And the question related to sort of speaking positively of like a 3-fund portfolio, even though in my case, I have small cap fund, so it's really a 4-fund, and then I have tips, which is another fund. And, I tell you what I do for whatever it's worth, but I think any number of these portfolios are quite reasonable. I don't there's no one answer to this. I mean, there's certainly what I would view as wrong answers, but oh, here it is. He emailed me. I'm guessing it's the same person. You talk about the 2 to 3 fund portfolio, but listen to your show. It seems like you say you own Vanguard funds during many. I don't own many. I own 3 Vanguard funds. Hang on. I will tell you what I own. Maybe. That's not what I wanted. Here we go. I'm just pulling up my spreadsheet, which you guys can all, not my spreadsheet, but you can download your own version. If you just Google like best investment tracking spreadsheet, you'll find it. Why is my spreadsheet not working? What have I done? Something in my spreadsheet went bad in a big way. I wonder if Google Finance is down. In any event, I'll tell you what I own. I own BND, right? I own VTI and VXUS. So that's the 3-fund portfolio, right? I do have a TIPS fund. So there you go. And I don't think that one is not a Vanguard fund, but doesn't really matter. And what else do I own? So I own a TIPS fund. I do have the Schwab dividend fund in my Roth IRAs, and that was just because I thought valuations looked attractive. And that's it, actually. I mean, there are like a couple of like very small amounts in different funds. We're talking like I have $50 in a cash fund just because I haven't invested it. So I don't think you guys are talking about that kind of thing. And then I own a few individual stocks. And then in some cases, I own the mutual fund version in one account and the ETF version in another, just because I've not gone in and switched the mutual fund version over to the ETF fund version. So I guess that's technically a different fund, but not really. So, I would say I'm probably a 5-fund portfolio, but again, that's because of that one issue, TIPS and BND, and then I have small cap. But yeah, I don't think that's different. I love the 3-fund portfolio, or 4-fund now if you had TIPS. But again, remember, if you found a fund that had both total bond market and TIPS in it, then you'd be back to 3-fund. I mean, the number, I like to keep the number as small as possible because of simplicity, but it's not the number that really matters other than simplicity. It's, you can do the same thing in fewer or more funds. Typically, the fewer funds you use, the less control you have on how much you've put in each asset class. The more funds you have, the more control. Some people want crazy control. I've got a good friend who probably owns 20 plus funds. He's got a big spreadsheet because he wants to choose himself how much gets invested in China. He wants control of that. Okay. And so he's got all these narrow asset classes and he likes doing it. That's what he does. At the end of the day, it's still a low-cost index fund portfolio. Not my jam, as the kids today say, but it works out. So anyway, I hope that helps. Yeah. Okay. Well, Jeff wants to know how far out one should build a bond ladder with rates still around 5%, 2 to 4 years. So Jeff, here's my approach to that. My approach is I have no idea because I don't know what rates will do. And therefore, I just put it in intermediate term bond funds, except for some relatively small amount in T-bills. You could build out a bond ladder, and you're probably going to do okay now because all the yields are reasonably high, at least compared to recent history. And if you keep rolling over the bond ladder, if you say 2 years or 4 years, but once you get it built and you're constantly cashing some in and buying whatever, the 2 or the 4 year, or whatever you're doing, as rates go up, your rates are going to go up. And as rates go down, your rates are going to go down. I personally haven't found ladders worth the hassle, but a lot of people do it, and it's not a mistake at all. I mean, it can be a perfectly reasonable way to manage your shorter term or even intermediate term, more safe assets, if that's what you like to do. But if I were building it, I don't know how I'd pick how far I went out. For me, it would probably be on what's the easiest way to do it. But which one is going to work out, I have no way of knowing. And that's important. I've talked about that. I think it's important to understand the limits of what we can know. If I were a pundit on a finance TV channel that I won't name, and had a lot of bells and whistles I could ring when I answered a question, I'd probably have a definitive answer to that question. But that doesn't mean I'd be right. All right. Noreen says, Ally has a no penalty CD. I believe it's 11 month at 4.25, no minimum deposit. Did that make the list? Oh, let's see. All cards. Let's go. Let's see. Here's the we go to no penalties. I just list them in order of the APY. Savebetter is at the top because one of the types of investments they've hit hard is the no penalty. I don't know why, but they do. So CIT Bank is the highest after the Savebetter accounts. Still pretty good, right? 4.9. Yep, there's Ally right here. 4.25. Marcus 4.25. A couple of Sally Mays. Those are both Savebetter. So you can see Savebetter, for whatever reason, their banks are really offering some good no penalties. But again, if you wanted a bank, there's CIT Bank at 4.90. And then again, if you said, well, I'll take a lower rate because I like Ally or I like Marcus, well, there you go. By the way, if you know of like higher rates, let me know. I'll put them on here. I can tell you for just all CDs, if you click this link up here, best CDs, you get all of the CDs we're tracking. And right now it's 946. And this includes brokered CDs. And I'm working on some functionality to help you include or exclude certain types of CDs. But this is literally, I mean, this scrolls down, it goes forever. And this Finworth, 552, but 50,000 minimum is the highest that we've found. Again, if you know better rates, let me know. We'll include them. Yeah. Okay. Jeff, for a couple already in retirement, is a 3 or fund portfolio. I'm going to say a 3.5 fund portfolio. Is it a good idea? It seems a lot of what I read and hear is geared to younger people with 30 to 40 years ago. I personally think it's a great portfolio. Again, I don't get hung up on 3, 4, 5, but a simple portfolio of a few low-cost index funds. If you think about what Bill Bingen did, he had a 2-fund portfolio, effectively. He had an S&P 500 index fund. I say index fund. He mapped it based on the S&P 500 with 0 expenses. It doesn't account for expenses. Of course, a low-cost index fund is going to cost you virtually nothing. But he had an S&P 500 and an intermediate term. It was intermediate term treasuries. So it wasn't an intermediate term bond fund like B&D. It was just treasuries. Now, he did other papers after that where he added maybe some international and looked at maybe some small cap. And the result was actually a higher safe withdrawal rate. But again, it's based on historical data. Future may be different, all those caveats. But I think a 3 or 4 fund portfolio, in my case, I guess it's 5 fund, because again, I have tips. That's what I do. I do have individual stocks, but you know, that's a different issue. It's like I'm gun shy. Like I'm going to get more emails. Wait a minute, you've got individual stocks? How dare you? That's fair. I think it's a reasonable portfolio for anyone. I don't think it has anything to do with age. And I also, by and large, don't think it has anything to do with how much money you have. I think a low-cost index fund portfolio with $100 million, you know, if I had that, would I have other things? The thing about $100 million is you might want to actually go out and buy some companies that you believe in or invest your money in a way where you can have more active control over what's going on. So I get that. But just in terms of the stock market, if I had $100 million, which in case my mother-in-law is watching, I do not, most of that would be in index funds. I'd certainly put some of it into individual stocks too, just because it's fun. But most of it for me would be in index funds. I'm going to guess I don't have to worry about that problem anytime soon. But if I live to be 190, then maybe compounding. Actually, if I lived to be 190, I would have trillions of dollars, probably. I mean, the compounding over that time period. Yeah, it would probably, I would probably, we all would. I mean, if we invested and just didn't spend the money. I calculated once how long it would take me to become a billionaire. I was pretty old, but it happened. And it was not 190. It's like 100, I don't know, 20 or 30. Why I think of these things. See, that's what I mean. If I actually publish the novel, you guys are going to read it and they're like, what? That guy is just creepy. Not creepy, weird, challenged. Maybe that's the word you'd come up with. Okay. What do we got? What's the next question? Fast Eddie wants to know the age of the people watching. Well, let's do it. Let's, if you guys don't mind, I'll do a Q&A. We'll do a poll, I guess it would be. How old are you? I'll say under 40. I can only put 4 options, so 40 to 50. I guess I would do 51 to 60. And then for the 60 folks, I'm going to say 61 or better. There you go. We'll find out. Kevel said he called FDIC and they said if Savebetter goes bankrupt, they have nothing to do with it because they're not a bank. That's absolutely true. Absolutely true. Right? And if Wealthfront went belly up, they're not a bank. Well, Wealthfront, see, some of these set up banks as separate entities. So I don't know if Wealthfront did that. Like Fidelity has a bank, but that's different than brokered CDs. So, you know, this is where it can get a little confusing. But you're right. If there's like a Wealthfront and they're not a bank, they went belly up, the FDIC's got nothing to do with them. That's true. That is absolutely true. I'm sure you guys all read about that bridge that collapsed in Philly. Isn't that awful? And it's like, it's going to take them months. I think I read 160,000. I think it was 160,000 cars go past that way every day. And the detour, I don't know if this will change, but the detour they set up, I assume you can't just shove 160,000 cars onto the surface streets. That's not going to work. So apparently the detour they set up was like 43 miles to get around that. It's awful. And then I think I learned today, I'm guessing the driver of the truck, passed away, which is awful. I don't know if there was more people. I don't really know. I just read a quick blurb about that. But by the way, before I go to the next question, I need to look at the calendar here. So, all right, 2 weeks from today is the 26th. So we will have a live show. And then we skip the 4th of July week. Okay, so that actually worked out. I was a little worried that we were going to hit 4th of July, but we're not. So this is interesting. Whoops, I hit the wrong one. So 2 or 3 fund portfolio versus Merriman ultimate buy and hold, which I think, depending on how you set, it has different versions, but can be like 10 funds, right? So I was emailing with Paul, and he is. I think this is at the Bogleheads conference. I think it's at the Bogleheads conference. He is going to have a debate with Rick Ferry. Rick wrote all about asset allocation, among others, but he ran an investment firm, that managed more than $1 billion. He's retired now. He's actually making his way, I think, with his wife. They're making their way across Alaska at the moment. They're going to debate whether, Paul is a big fan of small cap value, and for good reason. Historically, it's done very well. But they're going to debate whether, I don't know the exact wording, but whether small cap value is a good investment going forward. And I guess Paul's going to take the side of yes, it is, and I guess Rick's going to take the side of maybe not. So that'll be interesting. Well, I find it interesting. I don't think anyone would criticize you if you're listening and you say, Rob, I don't really find that all that interesting. This is a great question from Scott about M1 is going to become their own clearinghouse. for trades, is that a risk? Honestly, I don't know. Scott, I don't know. But I think it's a good question. I'll look into it if others do, and I don't know. I don't offhand. I mean, they're probably. I assume they're doing it to save money, but I've never seen the behind the scenes working of a clearinghouse, so I'm not certainly by no means an expert on that. All right. I'll just put this comment up from Han. Referring to trying to talk to your aging parents about the estate. It 100% depends on how receptive your aging parents are and how you present it. My parents were very resistant to giving up their scamming managed portfolio manager. Trying to think, Han, what your view on that manager was. Oh, I see. The scamming word probably gives it away. Yeah, and at the end of the day, what can you do? We have a right-wing professor in the house. Your thoughts on funding an annuity with an income rider. So whenever you start with income rider, I'm out. I'm done. Using Roth dollars. This will create 100% free tax income to augment 70,000. So I'm pretty confident, without seeing any details, that it wouldn't be something for me. What I recommend people do before they go down that path is meet with an hourly investment advisor who's not selling insurance, and have them look at it for you, and they will give you their unbiased professional opinion. I'm not an investment advisor. I've not spent my career studying income annuities. I have a list of them on robberger.com. It's actually, I need to create a short link for this. Let's see here. Here we go. So if you just Google, a list of low-cost financial advisors, you like my parenthetical, say no to 1% advisors. I like that. And there's a bunch here. Obviously, do your own due diligence. They're going to charge you. It depends what you're having them do. It could be a flat fee, it can be an hourly fee. But whether you use one of, and by the way, I have no financial relation. I don't get paid by any of them for anything. But whether you use them or not, that's what I would recommend, because these get very, very complicated. And when you talk to the salesperson, they're going to use assumptions that show a pretty rosy outcome. And I just think folks ought to get an unbiased opinion. RJ, my previous answer may have answered your question, but it says, great show and awesome channel. Thank you. Thank you. Is it smart to create a bond ladder? And if so, how to build one? Well, we can talk about how to build one, right? It's no different than a CD ladder, really. Let's say you wanted to end up, so the theory, here's the theory behind a ladder. In a normal yield curve, the shorter the term, whether we're talking about a CD or a bond, the lower the interest rate. So you think, well, with CDs, you think, boy, I'd love to get the interest rate that a 5-year CD offers, but if I need the money early, I'm going to get crushed with the penalty. Crushed may be a bit of an exaggeration, but I'm going to pay a penalty I'd rather not. And with a bond, the concern isn't a penalty, because you can always sell the bond, assuming we're talking about marketable bonds like Treasury bills, or which are shorter term, or longer term Treasury bonds. But you could end up selling them at a discount because the interest rates have gone up since you bought them. So it's a different kind of risk, but it's the same potential outcome. I need the money sooner than I thought, and I end up having to either pay a penalty or possibly selling it for less than I paid for it and losing some money. So the idea of a ladder is, and it takes time to build it, but you could start out, let's just assume every year. So you begin with buying a 1, 2, 3, 4, and 5-year CD, so 5 different CDs or bonds. You could even mix them. You could have bonds for some of the terms and CDs for the other, I guess. And then what you would do is, and so the idea is every year some money will come due without penalty or without having to sell at a discount, because the bond will always be worth face value at maturity, right? And what you do is when the first one comes due 1 year, you roll that into a new 5-year CD or 5-year bond. And so now, then when the next one comes due, which will be a year later, when you started, this would be the 2-year term, but when we finish the second year, the 2-year comes due, you do the same thing. So what happens after that, you cycle through all of them, is you have 5-year CDs or bonds, and one matures every year going forward. So you're never more than a year away from your next payday, so to speak. Of course, you're getting interest, but in terms of the maturity, the CD or the bond maturing, you're never more than a year away from 20% of your money, right? Assuming you put the same amount in each one, and you benefit from in most cases, higher rates on the 5-year term as compared to shorter terms. Now, there are going to be times when you could be, imagine you're in the 5 years bond now. Let's go look at, brokered CDs. Brokered CD rates. I think Fidelity comes up first. Yes, it does. Oh, Vanguard does too. So imagine you did this 5 years ago and you got your 5-year CDs and they're all rolling over one every year, and you're earning, we'll call it 4.5%. And you're like, well, that's no good. Look at this 3-month, heck, 12-month. I get 5.35. What a bummer. Now, of course, this is not normal, but it happens. It's happening now. Inverted yield curves, what they call it, right? So normally the 5 year is going to pay more, but not right now. So if you have a bond ladder, there could be times when you sort of quote unquote suffer. I guess whether you suffer at 4.5 versus 5.35 is just going to depend on your personality, I suppose. You just have to keep that in mind. And then kind of to the earlier question, well, should we do 5 years? Maybe we should just build a bond ladder out 3 years. Yeah. I don't know what to tell you there. Part of it depends on how soon you might need the money. I don't think 5 years is unreasonable, but again, you could end up in situations where for some period of time, you're actually earning less than if you just had all your money in a 3-month T-bill. And the thing I wouldn't do is chase rates. I'd get an answer if that's what you want to do, a bond ladder, and I would just stick with it. That's true generally, however you want to invest in bonds or sort of secure cash investments. And here by bonds, we're pretty much talking about treasuries. Obviously, if you get into high yield or something, then you have different risks and whatnot. Okay. Pardon me. Let's look at the poll. Let's see, how old are you guys? Let's see here. So the biggest group is 61 or better, 41%. And then the largest group is 51 to 60 at 31%. So this is definitely a older crowd. There's 15% of you are under 40. Boy, to be under 40 again. Anyway, and 13% are 40 to 50. I'll leave that up for now. But I'm a little surprised. I know my channel skews towards the older because it's aimed for people in or near retirement. I'm a little surprised that it's that significant though on this show. I don't know why, by the way. Okay. What time is it? 8:03. Oh, we're doing fine. By the way, I've been watching Silo. I love that show. Absolutely love it. Are you guys streaming anything good? I've started to watch The Crowded Room, which, first of all, it bothers me that I don't know why it's called that. So that's problem one. And it's out there. I watched the first season of From, which I enjoyed quite a lot, and then learned that actually a second season is out, but you need to subscribe to one of whatever the streaming service is. The first one was free as part of Amazon Prime, maybe. So I guess I'm going to buy, I forget which service it is. I'm going to at least sign up because I want to watch the second season. Oh, it was pretty good. So this is going to be a spoiler alert kind of on From, but if you've watched it, well, first of all, wouldn't you try to capture one of them? Like, I don't know, like dig a pit, and fall in it, like, and see what happens to them during the day. Anyway, I don't know. The season 1 ended. It was pretty freaky. All right. I've completely lost the thread of this. Where am I? Okay. Looking for a question. Remember to tag me. Back to that question about 5% to start out and then trigger Social Security. Vinyl thinks that's asking for trouble. Could be. Don't, I think a tool will help you. All right. Looking for a question. So Kat wants to know what maturity for tips. Well, I can tell you what I do, and that's intermediate. I have an intermediate term tips fund. That's just what I'm comfortable with. Maybe it's just because I can't make up my mind. Short term, long term, I don't know. How about intermediate? No, I'm comfortable with that. It gives me more return in theory than the shorter term, but doesn't take on all the risk of longer term. Well, so this is a great question, Mariana. Isn't it better to invest in individual government bonds rather than government bond funds, because bonds might have to be sold by fund at a loss while individual bonds can be held to maturity? So it's absolutely true that a bond fund that has an objective to maintain a certain maturity or duration will buy and sell to maintain that duration. And it's true that if rates have gone up and they sell, they're going to sell at a loss. The flip side is if rates have gone down, they could sell at a gain. But regardless of which one they do, let's say the rates go up, so they've sold at a bit of a loss, but by selling and buying more current bonds, they're getting bonds that have higher yields. And so basically, as a general rule, now I don't know if this applies to tips. Tips might be a little different. But in any event, if you hold a bond fund like BND for a certain period of time, you can expect to get a return that's equal to its current yield. And you say, well, great, Rob, how long do I have to hold it? Well, you have to hold it for a period of time roughly equal to the bond fund's duration times 2 minus 1. Now, some of you might be asking, what the heck is duration? So duration, you can think of it as the average time it will take you to get all your money back from a bond. And how do you get your money back from most bonds? Well, you get interest along the way, and then you get the face amount of the bond back when it matures. So a 10-year bond, most of the money is going to come back to you at year 10. But some of it's going to come back every 6 months when interest payments get made. And so maturity would be 10 years when you buy it if you bought it new. But duration would be shorter than 10 years because it's sort of think of it as a weighted average of when you're going to get your money back. And by the way, the higher the yield, the lower the duration, right? Think about it this way. How big are those interest payments you're getting every 6 months? Well, if the yield is sky high, you're getting a truckload of money every 6 months. That shortens the average time you have to wait for all your money to get back. I hope that makes sense. So the duration of a fund or a bond can change. And of course, it changes every day too, because the maturity gets shorter. So if you look at a BND, it's probably 6.5 years. We can take a look. I can show you how to find it. Just go to Morningstar, put whatever bond fund in you want. We're going to look at BND. Go to the portfolio. Yeah, I said 6.5. It's 6.56. I feel so smart. So you say, wait a minute, Rob, 6.5 times 2, 13 minus 1, 12, 12 years? Well, yeah, it depends on your time frame. I think people even in retirement, 12 years is, and this is rolling over time too. It's not set in stone, but so over the next 12 years, we could guesstimate that this fund is going to return about 4%. Now, of course, you say, well, wait a minute. How can we know that? Because interest rates could go up or down. The movement of interest rates, though, affect a bond fund or a bond fund, both positively and negatively, right? As we've pointed out, rates go up and they have to sell to maintain their duration. Yeah, they sell at a loss, but they're not just selling. They're also then buying new bonds, and those have higher yields. So eventually those higher yields fill in the hole created by selling at a loss. And if you sell at a gain because rates have come down, you feel so good, look at this gain we've got, but you've replaced it with lower yielding bonds that eat away at those gains. And 13 years later, you're pretty much at what the current yield is today, roughly. I don't know. That's what I've got to say on that. Now, you could buy like a bullet share. If you said, well, I want treasuries, and I want the benefits of a bond that I can like hold on to maturity and not see any losses, but I'd like the convenience of a bond fund. I bonds is another one, not I bonds from Treasury Direct, but small I, BONDS is a fund type that does the same thing. But if I can get to the website, we'll look at bullet shares. Here they are. And they've got, I guess do they not have, so they have investment grade. They don't have treasuries. I thought they had treasuries, but maybe not. You can pick your duration or your maturity. The way this works is, let's say you buy 2028 investment grade bonds, we'll just say. This fund will basically wind down and close in December of 2028. In fact, it'll even tell you that here somewhere. Oh, here we go. The fund has a designated year of maturity of 2028 and will terminate on or about December 15th of that year and give you all your money back. So this sort of acts like an individual bond, but it's actually a fund, an ETF that holds a lot of bond funds. I don't know if I mentioned I bonds. Let's see. Again, not the I bonds from the federal government. This is part of iShares. From a marketing perspective, I really wish they wouldn't have called them I bonds. But here we go. Right? Do they sell? So you can see, matures like a bond, trades like a stock, diversified like a fund. I wanted to see if I could. What do they got here? Oh yeah, they have U.S. Treasuries. And bullet shares may have those as well, but U.S. Treasuries. So you could say, oh, I want to go out whatever to 2030, and it's a fund, but it kind of works like an individual bond. Or you could just buy individual bonds if that's the thing you want to do. But anyway, Mariana, that's my way of looking at bonds and bond funds. And I've probably put you all to sleep, and I'm sorry about that. There's a great book, by the way. I don't know if it's on my shelf here or upstairs. I'm looking for it. Don't see it. It's got a really difficult name to remember. It's called The Bond Book. Great book on bonds. The Bond Book by Anne, what's her last name? Thou or something. Yeah, Annette. Here it is. The Bond Book. I've read it a couple of times. Yeah, if you want to dive into bonds, that would be the book I would recommend. Okay. I'm glad you guys, in the chat, keep yourselves entertained while I blather on about bonds. You probably, and that's okay. You mute me. I get it. And you just go into the chat and chat back and forth. I would probably do the same thing. Well, whoops. Here we go. Trap Jaw wants to know about the risks of investing in a very small ETF. Well, one thing is that, trading volumes, depends how much you're investing, first of all, but trading volumes are typically small, and so there can be it can trade at a wider discount or premium to the net asset value. So that's one concern. I would be concerned too if for most people, myself included, this is not a real issue, but if you had a lot of money and you were going to end up owning a large portion of an ETF, I don't know that would be kind of where I'd want to put myself. I'm not familiar with DSMC. So it's premium now. The spread that we're going to see now will be ridiculous, but that's because the market's closed. So you can see the bid-ask spread is 56% wide margin, but that's, you got to let the market open up and look at it during the market, at least sort of a half hour in. But it still could be a wider margin. Like a VTI is going to have almost no spread at all. So that would be an issue. Yeah, this is really small. I would be a little uncomfortable with that. And I guess my question would be, why do I want to invest in this? Also, the expense ratio is 55 basis points, which is not, by most people would not in the industry would say that's not outrageous, but it's more than I would want to pay. And so I would want to know, well, what's so special about this small cap value fund as opposed to any of the other small cap values? That would be it's a question. All right. If you're in a high tax state, why would you buy a bond fund versus just buying Treasury? Well, first of all, you might buy them in a retirement account, right? So that would be one. But if you were investing in bonds in a taxable account, and you lived in California or New York, you'd probably, if not Treasuries, because they're not subject to state and local income tax, you might even do a municipal bond fund too, right? Yeah. All right. This is a good question, Peter. Is it worth following asset class location rules? How much are you really going to gain? That's a good question. I've never actually done the math, so I don't know that I have an answer, but there has to be studies on this, which I'll see if I can find later. But the other thing I'll say is, Michael Kitces comes up from 2013. I'll have to look at that. Here's the article, by the way. But I don't know if this is going to be helpful. So I'll look at it. But the other thing I would say is it's not hard to do. So why not? But I couldn't put a number on like what the value is in terms of increased return. But I know there are going to be studies on it. So I'll see what I can find and report back in 2 weeks. Maybe I'll do a video on it. I do have a lot of videos planned. I'm going to be, I think ramping up the video production. Jim wants to know, why would you buy VTI over SPY? Well, VTI is a total U.S. stock market fund. SPY is S&P 500. So, right, I'm pretty sure. Yeah. So you get a broader exposure with VTI, although I did a video on total U.S. market versus S&P 500. This was at least a year ago. You can find it on the channel. And returns and fluctuation, variability, volatility, pretty much the same. I still prefer VTI just because it's like, well, they're the same, but why not take the extra diversification? But yeah, it's hard to argue one way or another. Yeah. I don't know what this is in reference to, Josh, but I thank you for coming to my defense. How is Rob supposed to know that? He can't see the future just like the rest of us. Heck, I'm not very good at seeing the past sometimes. Oh, Josh is offering a token crystal ball. I like it. Maybe those 8 ball things, you turn it over and it gives you the answer. I'm showing my age there, I know. Jeff says that Buffett recommends a 2-fund portfolio. That's true. 90% S&P 500, 10%, I think, short-term treasuries, right? I personally would not go with that portfolio. But, you know, it's an approach. I know disagreeing with Warren Buffett on investing is not a smart move. Okay. This is from Carolina. For a low income retired person with only $50,000 in an IRA, what mix do you suggest? Well, I'll tell you how I would think through the question. The first thing I would think about is, how am I going to use that $50,000 in retirement? Am I going to take a little bit out each year? And if so, how much? What would happen if I didn't have that money? How badly do I need to rely on it? You said a low income person. So presumably there's Social Security. There may be other sources of income, perhaps. And so the reason I would start with those questions is because I think it's important to understand how much of that $50,000 you're going to spend each year before you start thinking about how you're going to invest it. Normally, as a rough general rule of thumb, if you spend 4% of that in year one, so $2,000, right? Am I doing the math right? Yeah. And then you can adjust that for inflation. It should, based on historical data, last you 30 years. Now, is that enough? Who knows? None of us, don't know how long we're going to live. I don't know how old you are now. But that's a rough rule of thumb. It doesn't mean that that's how the future will play out, right? We can't predict the whole crystal ball thing. We can't predict the future, but as a general rule of thumb. And if you're going to follow that kind of approach, I think generally 50 to 75% in stocks. That's what Bill Bengen came up with. And I think subsequent research has confirmed it. Again, it's not that that's a guarantee. And that if you do that, it'll last you 30 years. We could end up in a worse scenario. But, in the absence of a better approach, that would be kind of how I would think about it. Now, you may say, I don't need to spend that much, or maybe you need to spend more, or maybe you're just not comfortable with that much in stocks. So these are questions you have to work through and figure out. I think if you end up going above 75% in equities or below 50%, at least based on historical data, you could potentially run the risk of having your money run out sooner than 30 years. Of course, in some scenarios, it actually worked out for the better and your money lasted longer. I mean, so again, keep in mind, this is more about rough general guidelines than it is absolute rules. And then the other thing I'll say is part of it depends on your ability to withstand the market fluctuations. Because if you have 50 to 75% in, say, a low-cost stock index fund or two, there's going to be some volatility to that portfolio. It's going to go up, it's going to go down. And, when you think about how it's worked out based on historical data, it's only worked out if people have stuck to that plan. If when the market goes down, you get nervous and pull all your money out, you're going to end up most likely with, worse results. And so part of the question comes down to your ability to live through those ups and downs without making changes to your portfolio. If someone said to me, I don't think I can do that, then I would probably be inclined to hold less money in stocks. Now, at this point, you may be saying, well, Rob, I appreciate that, but that's kind of generalities. I want a specific answer. I can't give you that. I can just tell you how I think through this issue. You could hire, again, a low cost like Mark Zoril. I showed you the page a minute ago. He's $239 for the first year. And then I think it's after that, $8 a month. And you don't have to stay with them. I mean, you could just get a one-time analysis if you want it. And I think if you want sort of professional advice, that would be a good way to go. All right. Vinyl wants to know if I'd go for 400 shares of Apple. What's it trading at? 400,000. It's a trading at like $1.80, like 182 maybe. So that's only 72,800,000. I don't know. Do they take cash or can I write a check? How does that work? I don't own that many shares of Apple. I can tell you that. So it's interesting. I want to show you this comment. It wasn't directed at me, but I'm going to read it anyway. So just started my retirement, rolling over my 401k. Big deal making this decision, but think I'm going simple. What's interesting to me. So imagine, you work for whatever 40 years. You save in a workplace retirement account. Maybe you build up a 6 or 7 figure portfolio, and it's invested. And because it's a workplace retirement, you've probably been investing it on your own. And you've done the best you can, and you've done okay. And now you're going to retire. And you want to move your money from the 401k to the IRA. And so when you do that, they probably take you all to cash. It's not taxed, right? Because you're just going to roll it over. And it goes to your IRA, and you're sitting there with $1 million or whatever it is in cash in your IRA. Now, you could just invest that money the same way you invested your 401k, or maybe you pick slightly different funds, maybe cheaper funds, maybe better funds, but they, same stock bond allocation, same US to international stock allocation, whatever. And it's so the result is really no different than where you were a week ago. But it's so scary to do. It's like, well, wait a minute. What if the stock market crashes? Well, what if you hadn't rolled it over? It was still in the 401k and it crashed then. Would you have been any better off? No. But it's scary. I know. I get it. I've been there. I don't know why it's scary. It doesn't make any sense. But it's scary. Okay. The people, the 13% that are under 40, they're like, what's wrong with these old people? They've lost it. Oh, yes, we have. Well, I have. Maybe the rest of you haven't. Okay. Here's a good comment from Kathy. So happy to see some under 40 here. As over 61, wish I would have been more aggressive in my 40s. Listen up. Amen to that. Listen up, you young people. It's just sad, though, that I'm calling under 40 young. I did 90 minutes of yoga today, and I didn't pass out, although the room was not as hot as normal, and that makes a big difference. Okay. What time is it? Day 27. I'm on comments that were left at 7:53. It's actually not too bad. I'm going to scroll all the way to the bottom and see what's going on down here. Yeah, here's Hani. He says, the first time I bought $100,000 worth of a single fund, it was scary. It is scary. Then you're worried like something's going to go wrong. You click the buy button, and it's like, what's going to happen? What else we got here? So LG has a solution for someone with 50,000. Should buy a 30-year bond, earn 4% till maturity. I could see someone saying maybe buy a 30-year tip. The problem with the 4% is you could get hammered. I mean, I get you. You're right. They would do great if the rates drop to 0, but we don't know that's going to happen. What's the real yield on tips right now? Wrong one. Hang on. I'll get there. Here we go. I'll show it to you. So the 30-year right now, can you see that? I'll put up, is 165. So meaning that's the after inflation return. That might not be a bad way to go. But again, I would talk to someone who can look at your entire situation. But I would be more comfortable probably buying a tip than I would a nominal bond. But that's just me. Okay. Now I'm looking in the last 1 minute. I'm looking for non-finance questions. Here we go. I think. You seem like a guy who sleeps well. How would you know? And is that a compliment? I don't know. Do you monitor your sleep, diet, exercise, and sleep equally important for most? So I don't monitor my sleep. There have been times when I've, used an app or something and tried it. I will say that generally I do sleep very well. I usually, they always say, no screens an hour before, and I'm on my iPad reading, close it, I'm asleep in like 3 minutes. Most of the time, I either sleep through the night or maybe wake up once, and I typically get 7 to 8 hours a night. Every now and again, I'll like wake up at 4 and can't get back to sleep. I just get up and sometimes I get up and record a video. But by and large, I do sleep pretty well. I don't know why. I don't sleep though as well as I used to. I do. There used to be a time when I would absolutely almost never wake up in the middle of the night, and I also dream a lot. I remember my dreams. I had a dream that I had a meeting with Warren Buffett. It was at my house, but it wasn't my house. You know how that goes. And I had an hour of his time. But I felt kind of guilty because you could tell while he was being very nice and whatnot, he wanted to get back to work. And so I only kept him for like 45 minutes and said, I know you're excited to get back to work, so you can, go ahead and appreciate your time. And he took off, I guess, heading back to Berkshire headquarters. That's just weird. Okay, this will be my last question, and going back to the Savebetter thing. If FDIC can't do anything if Savebetter goes down, then what's the use of pass-through insurance? So the idea of pass-through insurance is that, so imagine you've got a Western Alliance, and Savebetter has an account there, but it's not for Savebetter; it's for Savebetter's customers, and it'll be titled that way. I don't know what it'll say exactly, but it'll say whatever. Savebetter for the benefit of Savebetter's customers, something like that. And so the idea of pass-through insurance is that the FDIC insurance doesn't belong to Savebetter, but it passes through Savebetter and belongs to its customers. So the customers get the FDIC insurance protection. So if Savebetter goes under, nothing's happened to the money. It's still at Western Alliance, right? And nothing's happened to the FDIC insurance. It's still there protecting on a pass-through basis. Now, exactly what would happen, Savebetter, again, if they went bankrupt, there's no reason that I can think of that would cause them to lose their records. So I don't know if they would, exactly how it would unwind, if they would end up taking those records and because remember, FDIC insurance won't kick in because in this scenario, nothing's happened to the bank. But my hunch is individual accounts would get opened at Western Alliance based on the records at Savebetter, or someone would just acquire Savebetter and take over what they're doing. Depends what kind of bankruptcy we're talking about. So yeah, that's why Savebetter going under wouldn't affect the FDIC insurance. It's a question of record keeping. But again, I don't know why a bankruptcy would cause any company to lose their records, right? But I'm sure there could be some scenario where that happened. I don't know. I just can't think of one. Well, there it is. It's 8:33. Well, gang, hope you have a great couple of weeks. I'll be back, Lord willing, and the creek don't rise in 2 weeks. Newsletter goes out every Sunday, so check that out with the link below the video. I am going to start, by the way, in addition to videos on the Rob Berger Show, Rob Berger YouTube channel, I am going to start publishing videos on the Dough Roller YouTube channel. Now, you'll know the difference in 2 ways. The first is, because the background is going to be the same, I'll be recording it here, but for the Dough Roller videos, I'll have a nice t-shirt on, not a button-up. I've decided to do that. I don't know why, but you'll see, oh, he's in a t-shirt. This is a Dough Roller video. Oh, he's in a button-up. This is a Rob Berger retirement investing video. The other way you'll know is I'm going to talk about general personal finance. budgeting, getting out of debt, how much life insurance should you buy, how to save money on car insurance, what are the best budgeting apps. I'll probably talk more about banking and credit cards than I do on this show. Occasionally, I do a video on that. But so yeah, check it out. I'll show it to you. It's got like 5,000 or 6,000 subscribers. So now the question is, can I get to 100,000 on that channel? I don't know. I'll show it to you though. It's called the Dough Roller Money Podcast channel because I originally set it up as just a way to publish the Dough Roller podcasts, but I need to rename it to just Dough Roller or something. But here it is. All of this fancy stuff and all these videos here with the fancy thumbnails, the previous company did. I've done 2, which are just podcasts that I also publish as videos. And you can see I'm in t-shirts, and you'll be happy to know that those are you ready? Are you guys sitting down? Untuck It t-shirts. No joke. I really ought to reach out to Untuck It. They should be paying me for this. They're not. So there it is. I'll have that. As Jeff's correctly pointed out, fancy schmancy. That is so true. Listen, great week to everybody. Thank you for supporting the channel and participating every other Monday. It's a lot of fun. Well, it is for me anyway. And yeah, until next time, remember, the best thing money can buy is financial freedom.